I just completed the second month of my 60 days options challenge with moomoo to see if I can beat the S&P 500 with options. And this time, I won every single trade I made. 12 trades, 12 wins, and I made a grand total of $485. That's 9.7% return on my capital. However, I'm not here to haul yen or anything, because the truth is that anyone can also be a good options trader as long as he or she is disciplined enough. In this video, I will show you how I did it and the rules that I use to increase my chance of success. But before that, full disclosure, this video is produced in collaboration with moomoo as part of an educational options challenge. But rest assured that all the views here are my own and all the trades that you are about to see are real, including losses. Options challenge is high risk, so please do your own research, and of course, none of this is financial advice. And if you want to see how much I made in my first month, you can check out my previous video here. And with that being said, let's not waste any time and let's jump right in. So first up, throughout my entire options challenge this time, I only traded credit spread. To put it simply, a credit spread is a strategy where you first sell an option to collect premium, then buy another option further out as protection. By doing so, this lets me reduce the capital that I need to perform the trades. That's because when you sell a normal cash secured put, the broker would require you to have enough cash to buy 100 shares. So for example, if you wanted to sell a $680 strike cash secured put on QQQ, you will need to set aside a whopping $68,000 in cash. Or when you sell a covered call, you will need to hold 100 shares. On QQQ, that's $69,000 worth of stocks, and sometimes ain't nobody got money for that. Meanwhile, with a credit spread, all I need to put up is the distance between my two strikes. So for example, if I sell a bull put spread at the $680 and $685 strikes, that gap is just 5 points, which means I only need about $500 worth of collateral. Now, of course, this comes with higher risk. With cash secured put, even though the collateral required is higher, if you ever get a sign, you are essentially buying the stock at the price that you're comfortable with, which is fine. Same thing with covered call. You do it because you don't mind selling the stock at the price that you want. So even if the stock gets caught away, you'll be fine with that too. On the other hand, with credit spreads, if the trade goes against you, you will simply just lose money. So that's the trade-off that you have to be comfortable with. Now, the nice thing about a credit spread is that you can do it in either direction. For example, if you think that the stock is going up, you can sell a put spread. Or if you think that it's going down, you can sell a call spread. But how do you decide which side to take? For that, one of my favorite tools is moomoo's trend projection tool. And I'm not saying that just because they are sponsoring this video. I'm saying that because I genuinely use it on almost every trade I made, even the ones outside of this challenge. So what this tool does is take moomoo's own technical analysis, run it through the AI, and match the current chart setup against thousands of similar setups from the past. From there, it draws a cone of where the price is likely to go next, and the shading inside the cone tells you a lot. The darker the color, the more likely the price would end up going in that direction. Not just that, it also tells me the odds of the stock rising the next day, plus how far it might move up or down. And that is incredibly helpful, because if the tool shows me that there's a good chance that the stock might go down, I can just sell a call credit spread to stay out of its way. Likewise, if it shows me that the stock is likely to head up instead, I can just flip it around and sell a put credit spread instead. Now, direction is only half of it. The other half is timing, because you can't just sell every day and pray that everything will work out. A credit spread works best when there's fear in the market, or basically, when the stock is more volatile, you will get more premium. Or basically, when the stock is more volatile, you will get paid more. Tastytrade actually measured this on SPY, and they found that when the fear is high, the difference between the average realized move and average expected move, aka the seller's edge, is worth around $10 a trade. But when it is calm, the edge drops to only about $6 for the exact same risk. So rather than trying to be like, premiums every other day, I wait patiently for the fear to spike, because that's when the same trade pays me the most. One simple way to check this on moomoo is to tap on Options, Analysis, then scroll down to Volatility Analysis. And right now, you can see that the IV percentile is sitting at 91%. That means that the current volatility is higher than it has ever been on about 91% of the days in the past year. As a rule, anything above 70% might be a good time to sell. So at 91%, options are about as expensive as they get. And this is exactly the kind of setup that I'm waiting for. Besides that, another tool I often use is moomoo AI. For example, if I'm not sure which is the better side to take now, I could just ask moomoo, should I do a put or call credit spread right now? I have a 7 DTE. And right off the bat, it told me a call credit spread aligns better with the current technical setup and high IV environment. And it breaks down exactly why. In this scenario, I agree with his thesis. So I placed the exact trade. And sure enough, it became my biggest winner of the whole round. Here's another example. I asked moomoo AI for its insights and it suggested a bear call spread. And same story, that one paid off too. Here's a pro tip. If you switch it over to the expert mode, you can even ask the AI to use the live options data and the unusual options activity and chart it all out for you. A few minutes later, it came back with a whole report. It told me to take the put side, then showed me why. You get a chart of the IV skew laid out for you, unusual options trade, the technical signals, and even a section on why not to do a call spread instead. However, with that being said, before you go and YOLO your entire accounts based on an AI response, do note that this is AI and not a crystal ball, yeah? Even if it shares a strategy with you, that doesn't mean that it will always be right. So just treat it as a second opinion and you still have to make your own judgment. Because after all, if the trade ends up losing, it is you who will be losing money and cry, and not the AI. Next, once you have decided on the direction, the next step is to choose the days to expiry or DTE. Typically, the best DTE to go for is 45 days out. Tastytrade ran a study on SPY and found that if you go anything lesser than 45 days, the markets would tend to move more than the options said it would. What this means is that if you go with short DTEs, you will be taking a lot more risk than the premium is actually paying you for. But at 45 days or more, the market tends to move less than the options said it would, and this will give you a slight edge. However, since this options challenge is just 30 days, I didn't have the luxury of time. Because of that, I decided to just go with 7 to 14 DTE instead. And sure enough, it almost cost me a few times. Take my 693, 698 put spread for example. After I opened the trade, the stock fell all the way down to 702, ending up less than 1% away from my strike before it turned back around. Henga. Then there was my 638, 643 call spread, where I needed triple Q to stay under 738. Instead, the stock rallied very close towards it before backing off. Now, I was lucky enough that the stock backed off. But if I were to run these short dated trades long enough, this would eventually come to bite me. That's why it's always better to go with longer DTEs, as it will give you the one thing that most traders don't have, and that is time. Okay, once you have decided on your days to expiry, the next step is to pick your strikes. Picking the right strikes is important because it gives you extra protection when things go wrong. For example, when I'm selling a put credit spread, I usually want my short strike sitting just below a strong support level. That way, if the stock ever drops, there's a good chance that it holds above that level. So during the options challenge, when I was trying to sell a put credit spread, I noticed that there was a strong support at $700 because previously, the stock kept bouncing off there. Because of that, I decided to just place my short strike just below it and went with 693 to 698. And sure enough, even though the stock later fell all the way from $730 down towards my strike, it never breached the strike because the $700 layer held and the buyers stepped in right back to push the price back up. On the flip side, when I'm selling a call credit spread, I would be looking for a strong resistance instead. In this case, I saw a resistance sitting at around $730. So I decided to go with the 739 to 749 call spread. And when the stock tried to rally back in early July, it couldn't break past $730 and the trade ended up in a profit. Now, if you are a noob at spotting support and resistance like me, you can check out moomoo's market position overview too. Every bar that you see here is a price, where people actually bought in. So the green bars are everyone who's currently in the green, and the red bars are everyone who's currently underwater. Then what moomoo does is take all those bars and mark out the support and resistance for you. Next, once you have decided your strikes, before you even place a trade, Moomoo's P&L analysis will give you a quick rundown of the trade. For example, the max profit of this trade, in order to break even, the stock needs to stay above $669, your max loss, and this trade has an 88% probability of profit. Then, if you are okay with this, you can just proceed with placing the trade. Last but not least, once you have entered a trade, it's also just as important to decide how you exit it. tastytrade backtested different exit strategies and found that if you hold your options to expiration, your win rate would be around 85%, and your annualized return on capital would be 20%. However, if you close your trade at 50% profit, both your win rate and your return on capital would go up to 93% and 34% respectively. The reason this happens is because when you close your trade at 50%, you lock in the win before the market even gets a chance to swing back and turn it into a loss. Not only that, the sooner you get your capital back, the sooner you can recycle the capital back into your next trade, instead of it sitting there trying to squeeze out the last few dollars. So throughout the challenge, I stuck to this rule and kept taking profits around the 50% mark. And if you follow this one exact rule, taking your profits and walking away instead of getting greedy, you will already be keeping more of your gains than most traders ever do. Also, if you don't want to sit there staring at the market waiting for a profit target to hit, you can just use a limit if touch order instead. You can set the trigger price that you want, and the moment the option touches that price, Moomoo would send out your order at the price that you preset. So you can go do your own thing and let the order do the watching for you. However, with that being said, there's one exception where I didn't close the trade early, and it's when I'm almost certain that the trade is going to expire worthless. So instead of buying it back, I would just let it run and keep almost the whole premium. Take my 750 to 755 call spread for example. With just 2 days left to expiry, the stock would have to rally more than 3% just to reach my short strike, and I was almost certain that that would not happen. So I let it run, close it for almost nothing, and kept 96% of the premium. Here's another example. With 6 days left to go, the stock would have to fall almost 5% to even touch my strike. So I let this one ride out too and kept 83% of the profits. Now, to be clear, this doesn't always work out, because even when the trade looks certain to expire worthless, a surprise event or Donald Trump could come out of nowhere and be like, surprise! And all of a sudden, you could end up losing money all over again. So while this strategy has worked here, it won't hold every single time. In short, you don't need any special talent to do well when trading options. Instead, what you need is the discipline to stick to your own rules. Get that part right, and the tools will do most of the heavy lifting for you. Moomoo's tools gave me the direction, roughly where to place my strikes, and told me when volatility was high enough to be worth selling. And the 50% exit rule isn't even mine. It is straight from tastytrade's own backtest. So how did the full 60 days go? Across both months, I made a grand total of $667 on my $5,000, which works out to 13.3% return. In contrast, over that exact same period, the S&P 500 only returned 0.7%. So does that mean buy and hold instead? Of course not. My average win here is only $32, while my average loss is $109. What this means is that I need to be right about 4 times out of 5 just to break even. So a couple of bad trades can easily undo a good month. That's exactly why I run both strategies. Buy and hold keeps compounding in the background, while options pay me a bit of income along the way. Now, if you want to try out options yourself, Moomoo's got a few perks that can help you get started. If you are new to options on Moomoo and sign up through my link, you will get 0 commission on options for your first 6 months, plus a $10 trading cash coupon after making your first options trade to cut your costs even further. And on top of that, you will also get up to $1,200 worth of sign-up rewards. And if you use my code Kelvin88, you will get an extra $100 worth of NVIDIA shares. Plus, you will also get a free copy of their options playbook after completing your trading task to help you pick your first strategy. For more details, do check out the link in the description below. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.